Hi stock investors, JJ here, welcome back. Well, right now I'm going to react to this video of Ed Yardeni saying that he thinks the market is in a market melt-up, a slow motion melt-up though. So let's see what he's got to say, what's his justification, and we'll see if we agree, if you agree with this.
We're joined by Ed Yardeni, he's president of Yardeni Research. Ed, it's good to see you.
Thank you.
Good morning. Ed, just overall, looking at 30,000 feet, seems like the labor market might be starting to ease a little bit, which would be probably friendly for the Fed's proposed action. Inflation also under control. How are you feeling? Sanguine about all these things?
I am actually. I kind of view what's going on in the labor market as normalization. I think everybody's looking at the data and saying it's getting weaker. It's only getting weaker relative to some of the pandemic-related data points that we had a year or two ago. The fact of the matter is most of the indicators suggest that we're back to a fairly normal labor market where jobs increase by 150 to 200,000 per month. Wages continue to go up, beat consumer price inflation, and the consumer has the purchasing power to continue to spend, which is what drives the economy.
Remember, the S&P 500 here is up 26.56% at this point when this video was shot. So that's over the past year, not year to date, over the past year, which is pretty impressive. And, you know, does this indicate that it is kind of in a slow motion melt up this year? It remains to be seen what will happen with interest rates and all that. He said the job figures, unemployment did rise a little bit. I'd made a video about that. The figures came out last week, but things generally look okay. Of course, it's election year. We're running up to an election in the US. So we'll see what else does Ed have to say.
Any eyebrows raised for you when you see the NASDAQ just almost, it looks like a stilt almost, and not necessarily seeing that across the board. Any trouble signs there?
34.35% up in the past year for the NASDAQ. Really good, historically good performance over 1 year.
Well, you know, we've both been doing this for a while, and I think we both lived through the 1990s experience. So there's a bit of deja vu all over again when we look at the market and compare it.
Deja vu all over again. That's a Yogi Berra, you know, quote there. Is it going to be like the 1990s dot-com bubble all over again? Some people are saying that this is going to go on. The AI-related stocks are going to run for years yet.
To what happened in the late 1990s, I think the way I would describe things is we're in a slow motion melt-up. The market just for the past few weeks has just continued to march higher to new record highs, and it's done it on disappointing economic indicators because I think investors have concluded that let's not worry too much about the economy slowing or even a recession, because if that were to even become a significant risk, the Fed will move pretty quickly to lower interest rates. I don't think the Fed needs to lower interest rates, but the Fed looks like they're ready to lower them if necessary.
Okay, that's interesting. He thinks that the Fed will lower and the market's not concerned because they haven't lowered interest rates yet and the market's been doing fine. The economy seems to be doing fine. So if the economy starts to slow down more, the Fed will increase interest rates and that'll help the market. I think that's the general feeling. And inflation seems to be under control. It seems to be under control. What do you think about this? Let me know in the comments about what Ed is saying here about the slow motion melt up and, you know, the market looking ahead and thinking that everything is okay and we're in the slow motion melt up.
In terms, I think we're going to get earnings starting at the end of this week, and then we'll be, you know, immersed for the next couple of weeks. What do you have an S&P earnings estimate for the next 12 months or so, and what type of multiple would you need to get where we are in the S&P?
Yeah, I think we're going to do $250 a share this year. That's up from $225 a share last year. I think next year we're going to do $270 a share, then $300 a share. By the end of the decade, I think we could be looking at $400 a share. Look, I think Becky just did a really excellent interview with the head there of Corning, and that just demonstrated that the AI story is legitimate. There's a lot of companies that are benefiting from AI. Not all of it's going to turn out to be as magic as being touted, but a lot of it will in fact be so. And I'm looking at during the second quarter for a lot of companies to give us some specific examples of how AI is starting to make a difference in their productivity and cost cutting.
Yeah, that's interesting because, a lot of companies have been talking about AI. Somebody, counted how many times AI is mentioned in their earnings calls without any real, earnings profits generated from that. A lot of it's been the spending cost, buying the GPUs, and from NVIDIA's been doing very well because it's been selling those. But these big techs in particular have been buying the equipment, and not a lot of profits being proved to come from AI yet. But he's saying here that it could start to happen. That could certainly be something that kicks the market along. And earnings season's about to start again, starting with the banks soon. So it's going to be fascinating to see what's going on there, what they say, if there's any real benefit to AI, and indeed if there were more new AI type companies that are IPOing. We talk about animal spirits in the markets, the 90s and 1990s. What happened there was many companies started to IPO on pre-revenue, and when we certainly don't see a lot of that yet.
All that said, Ed, do you spend any time losing sleep over how much money we owe, the federal government owes at this point?
I worry about it during the day. At night, I tend to sleep pretty well.
You did melatonin?
Look, we've been doing, again, you and I have been doing it for a while, and anybody who's been doing it for a while can recall that the deficit issue has been a day of reckoning issue for a very long time, and the day of reckoning just keeps getting postponed. So I'm still in that camp that it's a problem. I tend to be an optimist, but I can't put lipstick on that pig.
I just watched a longer clip on Bloomberg with Howard Marks, super investor Howard Marks, great investor. He sort of said this. He was asked a similar question about the debt and everything. And he said it's a concern. It's definitely a concern, but he just can't put any timing on it. He wasn't prepared to when that will come home to roost, when that will be a problem. Everybody kind of knows it's a problem there in the background, but nobody can really put a time on it. You can't put a timeline on these things. Nobody really knows what's going to happen there and when, specifically when.
And I guess my thinking is that the day of reckoning will come, and when the day of reckoning does come, there will be a political solution. It's a man and woman made problem. It's not as though we can't at some point come up with a program that over a 10-year period reduces outlays, or the growth rate of outlays relative to taxation, and that taxation has increased somewhat. But for now, Janet Yellen's figured out a very simple way to calm the bond vigilantes down, and that is anytime they worry about too much supply of bonds and notes, she just says, okay, so we'll do more of it in bills, and that calms the bond market down. In addition, the inflation numbers have been great, and I think they're coming down to 2% here pretty quickly. And that, too, I think will placate the bond market.
Yeah, the inflation is coming down within the range. Fed Chair Powell said that they want to see that really come down, and so the market's kind of looking ahead here and thinks that's under control. It's definitely better than, remember, it got up to 10% there. And suddenly everybody was very, very concerned. Anyway, what do you think of this? Do you think the market's in a slow motion melt up and it's going to continue at least for the rest of this year? As I said, I'm not giving any recommendations at all. I'm not allowed to do that. I'm not doing that. Investing based on macro, I don't think it's a good idea, or just on the direction of the stock market, even though a lot of people do try and predict the short term. So it's just for general entertainment and general education purposes, and this kind of thing is entertaining, I think, to watch the market. It's in a slow motion melt up, if that's indeed what's happening. What do you think? Let me know in the comments. And on screen, I'm going to put a link to a video that YouTube thinks that you should watch next. It might be one of mine, it might not. And also put a subscription button on the screen if you want to subscribe and follow along, because I'm doing these kind of videos pretty much every day the market is open. So follow along, and thanks for watching, and I'll see you in the next one.